I want to ask you, long kind of view here. When you guys started Apollo back in 1990, here we are 36 years later. What's changed when it comes to the private markets, other than just size?
Size, complexity, the solutions that private capital providers can provide. Back in 1990, all the commercial banks were providing senior debt financing, which is where the BDCs and private credit have picked up the slack since the GFC. So back in 1990, none of us were doing senior secured financing. We were all doing junior type capital, whether it's equity or mezzanine or sub-debt. Today, the private credit world has evolved to the point where it's kind of taken over the senior secured market because banks have been forced to exit because of increased regulation.
Good or bad? Was that a good thing? Great for the growth of an industry, but what's your take?
Kind of depends who you are.
Yeah.
It's interesting if you think...
explain that.
So if you think about, the explosion that's taken place in private credit, over the last 5 years, there's been $250 billion raised for these non-traded BDCs. Question, is that a good thing or a bad thing? And as I think about private credit, there's kind of three very important constituents. There's the borrowers who are borrowing from people ourselves. There's the asset managers like ourselves who are raising this money and investing it. And then there's the investors. So is this increased scale good for certain people? It's certainly good for the borrowers because they've had increased leverage with all the capital that's been raised to kind of get very advantaged terms. It's certainly been very powerful for the asset managers, the public asset managers in particular, because it's fee generating. But arguably, is it good for investors? Is this increased scale good? Is it improving returns? I would argue that it's not, that the need to put out all this capital in a relatively short period of time has put pressure on returns. And so yields have come down over the last several years, not because of interest rates coming down, because spreads compressed and because of all the increased competition.
Are these just growing pains?
Look, I think our industry is here to stay. So the answer is yes, it's growing pains. But it's also a question of kind of where the right incentives are. Our job as an investment manager is to find the best risk reward for investors and not just grow for growth's sake.
You made an interesting comment moments ago where you talked about the type of lending that has gone to private credit in recent years as a result of banks not being able to do it because of the regulatory environment. I think for a lot of people, hearing that on itself might be a reason for concern. It's a asset class or an area of the market that doesn't have the same transparency, the same regulation as a traditional quote unquote big bank. Does it need to be regulated in a different way?
I personally don't think so, because if you think about where people are concerned about risk, it's systemic risk, it's too much leverage in the system. Private BDCs, private credit funds, public BDCs are not levered more than 1 to 1.5 to 1. Banks are levered 10 to 1. CLOs are levered 9 to 1. So there's not a bunch of systemic risk in the system where a series of defaults is going to create a downfall. So I personally don't think there needs to be increased regulation.
Michael, is it just as simple, like playing off of what Tim said about growing pains? Is it just a case that it became too big and too much money chasing deals, and so it leads to maybe deals that maybe shouldn't be done and that kind of thing?
It's too much money raised too fast, having to get invested.
Yeah.
And what that's created is significant competition such that the private equity sponsors, who are the primary issuers of this debt on behalf of their portfolio companies, have increased leverage over the debt capital providers. So they can go to them and say, if I'm going to give you my loan or let you finance my company, you're going to have to accept a lower rate, a higher leverage ratio, and less covenants. And so that, I think, has relaxed underwriting standards and has potential risk going forward of increased defaults and increased losses given defaults.
There's things going on to macro, and I just want to throw in a couple of headlines just because they're crossing the Bloomberg, whether it relates to what we're talking about, but I just want to bring them to us. PIMCO weighing $14 billion debt deal for Oracle data center, so that plays into the AI. And then we have dated Brent oil price hitting a record of $144.42 a barrel. There are macro issues.
Those things not unrelated to what's happening in private credit.
But we think, no, exactly. Like I think about artificial intelligence. We've talked so much about the SaaS world. Like, so roll those in, and how that has also been major factors, or they have been major factors.
So the macro factors can definitely have an impact on performance. If we're in a world where oil's gonna be 150 for a period of time, that's gonna have a tremendous impact on the economy. And even a
not
greater,
just private credit, but
exactly, on the economy. But because private credit, these are levered companies,
right,
that impact is magnified. And so companies that were created 3-4 years ago when rates were zero and companies were leveraged 6 or 7 times that haven't grown to date to support those capital structures are even more at risk because of these macro factors. I think it's very important within private credit today to focus on areas that may be more immune from that, primarily like asset-based lending against hard assets as opposed to against cash flows that are more volatile.
Well, that's a big category. So sort of dive into that a little bit for us and where you are finding opportunities.
We beginning in 2009, coming out of the great financial crisis, identified the fact that banks were being forced to exit not only cash flow lending, but asset-based lending. So we began building out a series of strategies, a series of infrastructure to support asset-based lending strategies like lending against receivables, factoring businesses, lending against inventory, lending to other commercial lenders against their portfolios, where we can do highly structured transactions, lend against hard assets that we can then monitor on a daily basis, so you can and protect ourselves.
Figure out values, right? You actually know what you're investing in.
Exactly, because we tend to be the sole lender to these companies. So the control we have is tremendous. The documents allow us to go in on a monthly, weekly basis and adjust the collateral value if we think there's a diminution of value, for example.
We'll go there because I think one of the things we talk so much about with private credit is transparency or lack of transparency. But as an investor or doing a deal, how much are you able to look into the investment itself? How often, how regular? And does every shop do it differently?
Every shop does it differently. I think because we primarily view this business as an investment business and not an asset gathering business, we're extremely hands-on. So when we make an asset-based loan, we do a field audit. We send people to the field, we verify the existence of the inventory, we value it. We send people to the field, we value that these receivables exist. There's been a lot of talk about First Brands and Tricolor and those frauds. Those are all avoidable. Had people done the work to verify the assets and were they in control of the documentation and been the sole lender to these companies, those things wouldn't have happened. And so what we do is all our transactions are directly originated with a counterparty. We do direct due diligence. Then on an ongoing basis, we're directly monitoring it on a weekly and monthly basis to ensure that our assets are being covered.
Which makes you wonder if that's where regulation should be, that there is some, I don't know, like some
It's a hard thing to regulate.
Yeah.
I mean, it's a hard thing to do. But the good news for us is that, again, back to the theme, commercial banks continue to be forced to kind of downsize that part of the business because the capital charge to carry those types of loans is very high, whereas we as an unregulated entity don't have those capital charges.
When you hear people say they're worried about contagion from this asset class, sparking issues in other asset classes, you're shaking your head. You don't see it happening.
I don't see it because if you think about it, people like JPMorgan, Wells Fargo are big lenders to people like ourselves. They hold billions and billions of dollars.
Yeah.
But they're lending at 50 cents on the dollar against a portfolio of senior secured loans. So the risk they're taking is fairly de minimis. And if you look back historically, no one has ever lost a dollar lending to a private credit fund or a public BDC or private BDC. Why? Because the regulatory environment for BDCs is such that you can't lever them more than 2 to 1. So there's already that very important check and balance in place to kind of prevent that type of contagion.
So what do you say to investors? Like we talk about, 40% of investors wanting out of certain funds. I'm just curious what you make of that. And then what went wrong? Did somebody, as our James Crombie, and I know you've talked with him, he says, look at that first page. It tells you that these things aren't that liquid. Yeah. So who's at fault?
So a couple of comments. And one thing I've learned from 40 years of investing in private equity and private credit is things are never as good as they look, and things are never as bad as they look. So on the way up, when this $250 billion was raised, things weren't necessarily that great. A lot of money to be put out. But people went and attracted significant retail dollars. It was fully disclosed that the structures were semi-liquid, that you had 5% restrictions, which was frankly is the right thing to do. But it's painful on the way down. And what's happened is the primarily people who are looking for redemptions are retail. It's not institutional. We raise money both retail and institutional. We're still seeing tremendous demand institutionally for private credit. Why? Because you hit on it earlier, Blackstone just raised $10 billion to be opportunistic. Well, this is a great environment to possibly invest in because capital's pulling back. That's going to put pressure on yields the wrong way for borrowers and the right way for us as investors. We view that dislocation as a good thing, provided you have liquidity to take advantage of it.
So potentially a good time to launch new BDCs just quickly, right?
Or to be involved in BDCs that are not fully ramped and have dry powder to take advantage of this cycle and not be embedded with kind of older vintage investments.